entrepreneur-owned companies, so typically the enterprise values are between 25 and 150 million in total value.
Right.
I think there was a lot of deal activity on the private equity side towards the end of last year. A little bit of softness in the first quarter, but we've seen a ton of new prospects coming through our pipeline. I think in the conversations that we've had with the sponsors that we deal with, they've seen the same sort of activity. So I don't know if that's a function of, entrepreneur-owned business confidence. They've seen their businesses pick up over the last couple of years and feel like now might be the time to do a transaction. It's kind of tough to say, but I think that's a little bit of what we're seeing.
Do you feel like the activity, kind of in the second half of 2012, driven by the Trump tax change, pulled a lot of activity forward, and now you're just starting to see things come back to life?
I'd say that's definitely accurate, and I think the folks that came to market in the first quarter of this year that were quality assets got a lot of attention.
Right.
So there's still a ton of private equity capital out there. There's a ton of private debt to finance those transactions. So if you were a quality asset that came to market in the first part of this year, you got chased.
Yeah, we've been hearing very similar things. And what you said about private equity, there's something like, it's around 400 billion of dry powder sitting in the coffers of private equity funds. I didn't have the slide today that comments on that. And then it's like 1.7 or so trillion of reserves held by commercial banks at the Fed in excess of what they actually need to have on reserve. So there's a lot of capital in the system, and with the Fed pumping more and more money into the system, there's plenty of capital out there. I think what you said about a lack of high quality deals coming to market, talking to sponsors, that's a pretty common thing that I've been hearing, certainly really for the past year. Anything that's high growth, a niche business, it's well managed, and doesn't have a lot of customer concentration, or there's something attractive about it. If there's an auction, it will get bid up to a very high, 9-10 times EBITDA. A weaker business is not going to attract that kind of attention.
Yeah, I think the last thing I'll add quickly is that if we kind of compare certain companies that we have in the market now versus similar companies a year and a half ago, the appetite on the debt side of those transactions. So we work with kind of $5 to $15 million EBITDA businesses. So companies those businesses were getting offers at, let's say 3 to 3.25 turns total leverage. That's now to 4.5, and the pricing is cheaper. That's obviously driving the increase in the leverage, but
and looser terms.
Yeah, I think the banks are still trying to, and a lot of those guys are the private debt funds.
Right.
Some commercial banks, I still think they're trying to be fairly conservative on the terms, but it's certainly looser than it was, 6, 12, 18 months ago.
Patrick, what about you?
Yeah, I was looking at some data the other day, and for leveraged loan funds, for every dollar that these CLOs are lending, there's $4 going into the coffers. So there's so much money awash, and with interest rates and the yields being so low, it's sort of counterintuitive why money's going into loan funds. But I think that people are expecting, around 2015 for rates to go up, so they're somewhat getting in early. So what happens is that the CLOs have to put this money to work. And whether it's leveraged loans or high yield, it has to be put to work. And now the spread between a high yield index, which is bonds at a fixed income rate, and leveraged loans, which float, is right now at 75 basis points differential. So the structural difference between a loan and a high yield bond is collateral. And so if you're an investor right now and you have a 75 basis points difference between being secured and unsecured, you're obviously going to go into leveraged loans. So it's even more money going into. But there's no place to put it.
Right.
So another interesting fact, I think it was 2 weeks ago, Wall Street Journal put out that leveraged loan funds and high yield bond funds typically under their charters have the ability to invest in public equities, which traditionally has only been about 5%, because obviously if you're an investor and you're investing in a high yield loan fund or a high yield bond fund, you don't want that manager buying equities. But over the last 8 months, that number has gone from, what was traditionally 5% up to 15 to 17% of the portfolio is equity.
Right.
It just means that they just have no place to put the money. But unfortunately, for some of the storied credits, I think you're still seeing a hard sell. And it was interesting what you put up about maybe the smaller banks are still sort of having a hard time and not as liquid with cash,
Right.
The community banks are still somewhat tight on purse rates.
Yep.
And then for stronger, larger EBITDA businesses, high barriers to entry, everything that makes a business strong, they're getting multiple offers. The primary origination market is still not absorbing all the cash.
Mhm.
That issuers are actually going back and getting repricings.
Right.
Which sort of got us into the problem 7 years ago in the first place. But leverage loans are being repriced, dropping 75 to 100 basis points, removing covenants and making it more issuer friendly. And the lenders have really no choice because there's no place else to put the money.
Yep. Patrick, what are you saying?
Yeah, I mean, just one thing, into this capital, we focus really on small businesses, so
Mhm.
what we see may be a little bit different. But think about companies with an enterprise value of 25 million and below, so kind of what we're talking about over here. And a couple things for you guys to consider. Just one, if you look at the demographics of the small business, most of them are owned by baby boomers. 70% of all small businesses is owned by that generation. And so obviously they're going to be looking for some kind of liquidity that is today over the next 15 years, and that's going to have a significant impact.
Can you speak up, please?
Oh, I'm sorry. In particular, we saw a pretty strong first quarter for M&A activity in small businesses and in different regions of the country, such as Sydney, Detroit. The number one contributor for somebody selling a business in the sector today is they want to retire. The second main reason is they're fearful of another recession. A lot of small businesses do not have the working capital that a larger business have, and they may not have the wherewithal to get through the next recession. So they're either looking to sell their business or looking to bring in a new partner or a new investor to help them get through that. They're very fearful of that. If we look back at the M&A activity in small businesses over the last 12 months, there's certain industries that are doing pretty well. And I would say that's manufacturing, a lot of activity there in small businesses, business services, consumer goods, healthcare, and technology. Most of the deals that we see are taking about 6 to 12 months to get done, so those are to get done. About 40% of all deals are not getting done in the small business sector. And the biggest reason is valuation gaps are still there between the buyer and seller, especially in business price. Sometimes the gaps are pretty large, like 20, 30% difference between the buyer and the seller. And then other reasons is just uncertainty about the economy. You may have a buyer that pulls out at the last second, or you may have a seller that thinks they're going to do better 6 months, 12 months down the road based on what they're seeing. So, we follow valuations very closely in the small business sector. They're definitely trending up, which is great. Just as an example, for companies with less than $1 million in EBITDA, transactions last year could have traded somewhere around 4 times EBITDA. And last year before it was maybe 3 to 4 times EBITDA. As you get larger businesses in the sector, say $2 to $5 million in EBITDA, the average multiple is about 5 times. For 6 to 10 million, it's about 5.7 in 2012, and from 11 to 25, it's really going to be the middle market, the lower middle market, 6 months. Again, industries that are commanding the highest multiple, at least last year, were similar industries: manufacturing, business services, healthcare, IT, financial services. We're also seeing an increase in seller financing to get these deals done. So typically, the small business sector would take seller financing of 20 to 30%, whether it's seller contingencies or notes or whatever. You're seeing a lot more deals where the seller's going to finance 50% or more to get a deal done. That is definitely the reality that we're seeing. Forecast for the future is all continued that there's no hit cuts. So it's cautiously optimistic, and you have a lot of push in the fact that you have a lot of small businesses who want some type of exit. But we think we'll see moderate improvement. We'll see continued increase in deal flow. We'll continue to see moderate improvement in valuations, but a very positive thing that we're starting to see is a stronger interest in strategics looking at smaller deals and as add-on acquisitions, and that's extremely positive for them. So this is something interesting. I think on the debt side, just real quick, it's still extremely difficult for small businesses to apply debt for all the reasons that you guys know. And if you talk to a small business owner, they have greater confidence in their business and their ability to grow this business today because they've been through the worst recession they've seen, and they got the funds to do so that they survive. But they also will tell you at the very same breath that they feel like the lack of capital is holding them back, and that we're hurting ourselves as an economic community because we're not fixing that problem. And that is a very consistent message from these small businesses. So, but I would say more than 40% of all applicants get declined in the small business sector. And the two main reasons is just inadequate in the bank's mind of cash flow earnings or lack of collateral. In fact, most small businesses require they have to put up a personal guarantee.
And you're talking about going to a commercial bank.
Commercial bank.
What's your experience with going to alternative sources, capital sources?
You know, mezz financing is definitely much more active in the small business sector. They seem to be trying to fill that gap, and they're easier to get to as long as you have steady performance. You know, they're not going to do anything that's risky. But then you're talking about cost of capital, probably let's say 10 to 20%, and maybe raise the cost. But they're definitely active in that field. They're doing investment, let's say between $5 and $10 million.
And on the point of seller paper and its increasing prevalence, do you see standard terms and pricing, or is that kind of all over the place?
All over the board. It's good. I mean, one thing about especially small businesses, every deal is very different.
Right.
I think one thing we're seeing, this is interesting for us that we get involved in all these, there's a lot more managed buyouts in small businesses. It's definitely one way to get things done, especially if there's a relatively healthy balance sheet. We can self-finance most of it. We did an MBO last quarter. This was all financed through the balance sheet. It involved a new MBO in the gas sector that will most likely be financed through the balance sheet. It's a good way for the owner to exit in terms that he or she is satisfied with, and it's a wonderful opportunity for management
To take over.
We're seeing significant traction in that area as an alternative for these businesses to create.
Yeah, I guess on the comment of the larger strategics coming in and looking at small businesses, smaller companies, that's driven in large part by just a lack of growth opportunities.
Yes.
They need to grow, especially if it's a public company. They want to consolidate, and the organic growth opportunities in the current environment just are so weak that acquisitions are really the way to go. So if you have a niche business with a good product or a certain customer base or a certain geography, that's going to be a lot more attractive to a large